The U.S. Fed
has cut interest rates
by 50 basis points to a new range of 4.75% to 5%.
This decision reflects our growing confidence.
The Fed has a dual mandate, and it has to worry about the labor market.
Half-point changes one way or the other are usually left for emergencies like a COVID, for example, or 9/11, for example.
As you may have heard the news that recently the United States Federal Reserve has cut down the interest rates by half percentage point. In fact, it's the first time in 4 years that the Federal Reserve has cut down the interest rates. Before this, they raised it 11 times in the past 16 months, increasing it to almost 5.5%. Now, you may have noticed that whenever the Fed cuts or raises the interest rates, it is covered very extensively throughout the globe, especially with reference to the stock market. So why is it so significant? How does it impact the global market, the stock market, and most importantly, what does it mean for common people of the United States? We're gonna cover all that in this video. Here are the timestamps. You can use them to navigate to a specific topic of your interest. So when the Federal Reserve increases the interest rate, it is mainly to combat the inflation, as Federal Reserve is the one responsible for keeping the inflation close to a standard rate of 2%. And this is very important because if the inflation rises above the normal rate, the prices of goods and services also increase, making it more and more difficult for common people to afford basic necessities like food, clothes, housing, education, healthcare, and a lot of other important things. As we can see in this chart that the inflation reached to more than 8% in 2022, which is considered very high for a developed country like the United States. That's why the Federal Reserve was constantly increasing the interest rates for the past 2 years. And as a result of that, the inflation came down to 2.5% in August 2024. Now one can ask as to how does cutting the interest rates decreases the inflation? Well, when interest rates are raised, the cost of borrowing goes up. So does the mortgage, the credit card debt, and personal loans. Due to this high borrowing cost, people and businesses take less loans, which limits the money supply in the market, meaning that people have less money to spend. And when people spend less, the demand also decreases, eventually forcing the prices to come down. And this is how inflation is controlled by raising the interest rates. Now, if the Federal Reserve cuts the interest rates, it is mainly for 2 reasons, either to combat unemployment or boost economic growth, or do both at the same time. As we can see in this chart that the unemployment rate has gone up in the past few months and is currently standing at 4.2%. If we try to look up to the numbers, then currently more than 7 million people in the United States are unemployed, and that's the main reason why Federal Reserve has cut down the interest rates. Now how it works is, when interest rates are cut, the borrowing cost also goes down. It means that people and businesses can take up cheap loans and invest it into new businesses or expand the existing ones. This requires them to hire more workers, which leads to an increase in employment opportunities and a strong labor market, which in turn decreases the unemployment. Also, when interest rates are cut, generally there is a depreciation of the US dollar, meaning the value of US dollar with respect to global currencies goes down, which makes the US exports cheaper and more competitive in the global market, which in turn boosts the economic growth of the United States. How does rate cuts impact the stock market? Well, the relationship between the interest rates and the stock market is a bit complex and often misunderstood. Generally, these two move in opposite directions, meaning when the interest rates are raised, the stock market goes down, and when they are cut, the market generally goes up. Now what happens is, when interest rates go up, businesses are impacted by higher borrowing cost, and they also have to pay more interest on their existing loans. So they may have to increase the prices of their goods and services to make up for the extra cost. But that's just one part. When interest rates go up, consumers are also left with less cash to spend, so the demand of goods and services also goes down. Now, on one hand, businesses have to pay high interest on their loans, and on the other hand, their revenues have gone down because of less demand and higher prices. This ultimately affects the profits of the company, and with a lowered expectation in the growth and future cash flows of a company, investors don't get as much growth from stock price appreciation. So they start selling the stock, finally resulting in a fall in their stock prices. Now, if enough companies experience declines in their stock prices, the key market indices like the Dow Jones, S&P 500 and Nasdaq will also go down. This is how raising the interest rates affects the stock market. but rate cuts have an opposite effect on the market. When the interest rate goes down, it means that businesses can now take up cheap loans and use it to finance operations and expansions at a cheaper rate. They may also have to pay less interest on existing loans. Moreover, consumers have more money in hand, so they too spend more on goods and services, which increases overall profits for companies. And if a company is showing profits and has a good growth prospect, investors put more money into their stocks, ultimately driving up their stock prices. Now generally the stock market goes down after an interest rate hike, but financial industry, which includes banks, brokerages, mortgage companies and insurance companies, is one such industry that tends to benefit the most from interest rate hikes, because as interest rate increases, they can now charge more for lending, which often increases their earnings and drives up their stock prices. But as I said earlier in the video, that the impact of interest rates on the stock market is more complicated, because apparently expectations also play a great role in the market. For example, let's say that the Federal Reserve is expected to cut the interest rates by half percentage point, but they instead announce a drop of only 0.25 percentage points. Now generally the market should go up because the interest rates have gone down, but the market was already operating on the assumption of 0.5% rate cut, so it may go down because the expectations weren't met. So we can surely say that how the stock market will react to the interest rate changes, but as a general rule of thumb, we can say that when the Federal Reserve cuts interest rates, it causes the stock market to go up, and when it raises the interest rates, the market generally goes down. How do interest rate changes affect common people in the United States? Well, if the Federal Reserve announces a rate cut, it is usually a good news for people, and there are some noteworthy changes in the market. When interest rates are cut, mortgage rates go down, also credit card interest and personal loan interest decreases. As illustrated in this chart, the mortgage rate line is closely following the Fed rate line. So looking at this graph, we can surely say that if the interest rate goes down, mortgage rates also go down, and if interest rates go up, so does the mortgage rate. This makes it cheaper for people to buy homes or refinance existing mortgages if they have a variable rate of interest, which can boost home ownership rates and stimulate the housing market. As in 2024, more than 34% people in the United States don't own a home, so a rate cut might help them become home owners. Now, when the Federal Reserve cuts interest rate, credit card issuers and banks also decrease their interest rates on loans. So if an individual has credit card debt or personal loan, a rate cut helps them manage their debt more effectively and also increase their disposable income. But to be honest, Fed rate cuts are not that effective when it comes to credit card debt, because as of now, the interest rates on credit card is nearly 23%. And let's say if credit card issuers adjust their rate as per the Fed cuts, that is half percentage point, then the interest rate will be 22.5%, which is still very high. So that's why interest rate cuts have very little impact on the credit card debt. But there are some other benefits of rate cuts, such as increased employment opportunities and economic growth. So this is how interest rate changes impact different sectors and people of the United States. I've tried to explain it as simply as possible. If I have made any mistakes in the video, I sincerely apologize for it. If you like this video, then this one is highly recommended to you. And also there is a question for you. Please share your thoughts on this in the comment section. Thanks for watching this video.